And a very good start to the day. We had almost 3-1 advancing to declining stocks. Carl, good morning, everybody. I think the important thing about today is this rotation that keeps going on, but there's not a lot of clear leadership. It just kind of keeps flip-flopping back and forth. Today, we've got semiconductors up, consumer discretionary, retail, generally considered to be cyclical groups. Banks, which were doing well a couple of weeks ago, kind of flattish now. Energy has been declining for the last couple of days. So the leadership is not clear. The point is that enough groups are up on any single day to keep basically the markets holding up. We've gone essentially sideways for the last 2 weeks on the S&P 500. We're only 1% from a new high on the S&P, but there's not a lot of new highs. We noted yesterday Walmart, Procter & Gamble, these are essentially historic highs. And once again, all of the utility stocks are the market leadership in terms of the new high, but that's been going on really for the last several months overall. So you see Southern Duke Energy at new highs. There's only one 52-week low on the S&P 500. We talked about this yesterday, and that is FedEx. FedEx is essentially near a 3-year low, not just a 52-week low. One of the great tropes of Wall Street beliefs is that FedEx is somehow indicative. When FedEx drops dramatically like this, that it's a sign that the U.S. might be going into recessions or those kinds of things. Bernstein had a very interesting paper out this morning, very academic, looking at the whole history of this belief on Wall Street that FedEx is indicative of the health of the U.S. and the global economy. And their conclusion was very simply here, the stock price, the decline in FedEx stock price does not indicate that a recession risk in the U.S. is higher. Specifically, the decline in the stock price is not indicative that the recession risk is necessarily higher, and that the impact on FedEx from the stock price decline is due to what they call idiosyncratic issues. They put that in quotation marks. They talked about elevated levels of capital spending, some poor investments they had done, stuff we have been talking about, stock-specific stuff. I think it's an important conclusion because this is a big belief on Wall Street that somehow FedEx is the canary in the coal mine overall. Kudos to Bernstein on this. Q3 earnings, well, we're not quite in the middle of it, but it really has started. We've had actually 8 companies that have reported so far. AutoZone reported today, CarMax, both of them beat. Although AutoZone, it looks like they might have had an extra week in there that helped them out here, but down slightly, fractionally higher here for CarMax. Again, 8 companies reporting. So far, the numbers are slightly negative for the third quarter, just like they were for the start of the second quarter. It does look like, though, if the historic trend happens, we're going to be positive slightly for the third quarter. So again, no earnings recession here. Q4 and, of course, first quarter of Q1 2020 are the big issues right now, but that earnings recession story that we talked about so much in the first quarter still hasn't happened this year.